Okay, so I'm quickly gonna jump back to um, trading view. We're looking at euro against the US dollar, right?
Yes.
Okay, so there's a principle that with currencies, because currencies and indices are quite different. So usually with currencies, you need to start in probably the highest time frames as possible, so you can get like a quick overview of the entire structure. So as you can see here, this is the daily. I'm just gonna scale up to the weekly time frame. So what you need to do first is get your highest point and your lowest point. So you need to spot those 2 points, usually using you can use a horizontal ray or line, trend line, or a rectangle, but in this case, we'll be using the ray. So this is our lowest point, and this is our highest point. So as you can see, the price has just been going sideways without really having a distinct direction. So we're just gonna focus on the current market, and we're gonna do the same. Lowest low and the highest point. So you can see that we have like a channel where the price is just going sideways, which means uh you don't know whether it's gonna proceed going down or it's just gonna go up and continue within this channel. But we kind of like a few tricks that we can use without actually knowing uh, the direction of the overall movement. So as you can see here, the lowest lows, we had a reversal and the market turned back inside, as you can see, right? So right before I get into that, I saw that you determined that down movement from this level here. This is, in simple terms, this is just like a double top pattern where you count the tops, which should give you two at a a horizontal level. So that is not enough for you to determine like, oh, okay, now the the trend is about to turn, because sometimes you can get that formation where you have double tops and then the price just continues and breaks through and keeps going up. So that is not a strong confirmation.
Right.
Yeah, you should keep that in mind. So anyways, um, with this chart, we don't really have a structure, or we can try to maybe connect some touches like this from the, which means this has to get out the way. So you can see that you kind of have this structure going on, and we can count the number of touches on the trend line, which is 3 touches. And using our trading strategy, the third touch, the third touch usually has the highest probability, which means when you trade off the third touch, you have a greater chance of succeeding. Okay, let me just remove those. And you need to check how the price got to your third touch. So usually price moves in a form of two ways, which could be an impulse where it just goes straight within the direction, or it could get to a third touch in a form of a correction where it trickles to um, the level where it's trying to reach. So it is important a price um, when a price reaches a level in an impulse, because it's called an impulse when the price just swings, whether a sell or a buy. This is the impulse, and the following movement is a correction where the price goes sideways. When the price reaches a level, let's say it reaches a high in a form of an impulse, two things can happen. You can either wait for reversals in the higher time frames to go back inside, or the price can just break and continue going up. So you need to know what the price is doing the moment it gets to that point where you could say there's like liquidity or whatever, but we don't really use those terms because we try to keep things simple. So once the price reaches the trend line or the high, for you to enter for a sell, let's say you predict the price is gonna reject and sell instead of a buy, you could wait for the price to reject and create an impulsive move to the downside where like the movement happens in like rather higher time frames. So once the price rejects inside, you are withdrawn from the risk of it basically buying. So you waited for it to react. You didn't initially uh, predict and execute. You waited for the price to do what it was supposed to do, and you wait for the correction. So remember, every after impulse, there's a correction. So you wait for the correction and you trade the correction. So remember, every after impulse, there's a correction followed by an impulse. So the price moves in a series of those two steps. So it's impulse, correction, impulse, correction, impulse. So your job is to recognize these corrections. You need to spot those corrections. So in this case, you waited for the price to reject, create an impulse, you waited for the correction to form, and that is when you decide to execute your trade, which limits your risk of the price reversing and going back inside, because now you have the rejection from the trend as your first confirmation, the the impulse to the downside as your second confirmation, and the correction as your third confirmation. So you have so much confluence for you to sell. So this is the first scenario. So I'm gonna draw the second scenario for a sell as well before I move on to the one buying scenario. So let's say the price reaches your trend line or your high, in a corrective manner. So it would be moving in that sequence. So what you know is the price didn't form an impulse, which means now it limits the chances of it buying. So it means you have a structure that looks like this. So you don't trade, you don't enter the moment it reaches that point, you wait as well. So in this case, you'd wait for the price to reject back inside or below the horizontal line with an impulsive move, which is significant or noticeable, nothing small, but something that you can see like, okay, this is obviously an impulse to the downside. So right after the impulse, a correction will follow. Usually these corrections come in different shapes or structures, if I may say. So it's quite difficult spotting these type of corrections as you need to be uh, very visual and alert. So you wait for that and you trade based off that correction. So these are the two cases that could happen. So I'm just gonna go back and refer to our chart here. So we're gonna focus on this part and focus on how the price got to our trend line or our resistance there. So you can see that the price started correcting once it reached the resistance there. So which means this is your first signal or confirmation that the price is going to sell. So you can see that it literally looks like this setup right here. So I'm going to show you where we had the corrective movement where, yeah, where you could have entered. So I'm going to scale down to the daily time frame. And as you can see, we had a very nice correction right there. Let me just remove these. And draw using the trend lines. And remember, the trend lines of these corrections, they don't really have to touch. You just need to know, like, okay, this is a correction, and you have this as your first touch, second touch, third touch. So you don't really have to struggle connecting the trend lines to these touches. So it's okay to draw like this, as long as you know what you're looking at. Anyways, so this is the correction that we had, where you could have entered at the third touch. Remember, the third touch is the touch that has the highest probability. So here is the first one. Let me just zoom in. Here we have the first one and the second one, followed by the third touch. So you can see the third touch had so much influence on the price just selling off. So you can see from that point, the price literally just sold off. Like 10%, that's like days worth of movement. So these this simple method where you try to spot these corrections it will limit your risks and increase your winning ratio because you are just trading based off like so much confidence in the price, because these are signals that the price itself gives to us. So people who trade price action using these impulse and correction movements, so many of them saw this, and that's why the price just sold off aggressively, because there was just so many people trading this third touch on the correction. So that was in the case of a selling scenario. So I'm going to show you this one where the price reached the level in an impulse, and then it rejected, formed the correction. So you can see here we had, it's not perfect, but I'll just use a different example because this is on the second touch and it's supposed to be on the third one. So this is how you should have analyzed euro US dollar, and since we're just back testing, we can focus on the current price before we move on to the other scenarios. So I just want to give you a prediction of what could happen with this euro US dollar. Are you still following along?
Yes.
Okay, cool. So you can see that we had a nice rejection from this support in the daily, and it was a huge impulse just going straight up. So I'm just gonna jump into the 4 hour time frame and look at what we have. So you can see, you can already recognize what's happening. We had an impulse with a correction, which means the price is going to continue, because the basic meaning of a correction is usually when it's followed by an impulse, it means a continuation. Rather, where there's no impulse and the price is just correcting, that signals a reversal. So you need to remember the formation of the correction itself. So in this case, we are coming from the support and the price just shot up, reversing by creating this huge impulse in the 4 hour time frame or the daily time frame, followed by a nice flat correction right there. As you can see, okay, I'm just gonna jump into maybe the 2 hour time frame just to get the 1 hour time frame, just to get our touches in order. So you can see when I connect all these touches, they actually sum up to 3 touches. We had, hold on, I'm looking for a tool. No, it's fine. Anyway, so you can see here we had, this is our first touch, this is our second, and this is our third. So remember, third touch, highest probability, you need to base your trades off the third touch. And we actually had something very interesting with this with this third touch. So I'm just gonna jump into the 50-minute time frame to show you how the market keeps repeating itself once you know these. So you can see how the price reacted after it reversed from the third touch. Um, we had an impulse followed by a correction, which is this. So it's the same principles, 1, 2, 3 touch, third one, highest probability. So it works from like big time frames scaling down to these small time frames. So if you didn't want to take uh, a risk entry in rather the 1 hour time frame where you just entered before the price reversed all the way, you could have just waited for the price to form a correction. So you wait for the impulse to complete and the price will just start correcting. And once it starts correcting, you need to uh, recognize all the points and then connect them. And the moment you see that, okay, we had the first, second, and the third touch, right before it gets to the third touch, make sure you pay so much attention as it'll give you reversal candlesticks. Are you aware of reversal candlesticks?
No.
You don't know what those are.
So finger sticks?
Reversal candlesticks.
Yes. So basically when we have like a longer week.
Okay, yeah, all those, yeah, you're aware of what I'm talking about. So once you see those reversal candlesticks and the moment they close, that's when you execute. So you can see here we had, this is our first touch, this is our second touch, and this is our third touch. And we had the nice long wicks, and right after we had a bullish candlestick right after the reversal, followed by another bullish candlestick right here. So we had two bullish candlesticks, which confirm that the price has indeed reversed. So you could have bought in right here, and minimizing your stop loss as you like, and the price just bought after that scenario. So you can see I'm basically explaining the same thing from the big structures and the big time frames and what happens in the small time frames. So it's just a repetition. And what I actually like about this strategy is that these things are so repetitive, like it'll basically become embedded to your brain where you easily like spot a correction. Like, oh, that's a correction right after a reversal. Like it's so easy to spot out once you become familiar with this type of trading style. So Euro USD at the moment it's buying. It's probably gonna break out this correction and just continue buying at some point. So that's the forecast with this one. So what I told you, it works in reverse. So it's the same thing happens with, in the case of like the price buying as I showed you right here. So you can just take a screenshot of this. So this is in a case of a selling scenario. So in a buying scenario, you basically just it works in reverse.
So basically what I'm saying here, both of these are selling, but if you go opposite way, it's buying, correct?
Sorry?
I said basically based on the two structure right here that you draw, it seems both of them are selling, but if you go the other way, basically it's a buying.
Yeah, let me just draw a buying scenario since I've shown you selling one. So I'm just gonna look for other pairs that I've worked on. Okay, yeah, I'm sure you're familiar with Nasdaq.
Yes.
So I recently, okay, let me just show you what I had with Nasdaq. I'm just gonna jump into my Google Drive, see if I have something. Okay, I think the screenshots are probably on my phone, so it's cool. So I'm gonna focus on this part. Let me just highlight it. This part. So I'm just gonna do the basics, get the lowest low. I'm not gonna draw the high side because we're focusing on this part. So as you can see, you can try to, okay, I'm gonna ask you a question. How did the price get to this low? And your options are it got there in an impulse or in a corrective formation. Which, how did it get there?
How does it get lower low? Is that what you say?
No, I'm asking whether the price, uh, whether it got there in a corrective manner or in an impulse.
It got there. Based on what I'm looking over there, it looks like you went there on a corrected manner.
This one.
Probably here that from no, yes,
It got there in a corrective manner.
that's what I'm looking for me. Yeah.
Okay, you are correct. As you can see, the price that this is a corrective manner. It's rather
So
like,
this whole thing is a corrected is a correction.
yeah, the price was corrected from this point. Yeah, because it was just doing this
Got it.
instead of just selling off like that. So which means eventually the price is gonna reverse. And right here we had this formation right here. This is the correction, and so the price did this. the price got to our support in a corrective manner, which signaled a higher chance of a reversal, and which it did. It reversed, gave us a huge impulse, followed by a nice correction, which signaled a continuation of the movement, and that's how it went. So that is what happened right here. As you can see, right after this huge impulse right here, we had a corrective uh, formation. I'm just gonna go to the smaller time frames and show you that we also did have like 3 touches. The 1, 2, 3 touch method. This was our first touch, second touch, and third. First, second, and third. After the third touch, remember highest probability, base your trade from the third one right after reversal candlesticks. And there you have it. And with indices, this is Nasdaq. This
Yes.
movement, catching this movement is very lucrative, very lucrative. So that's how you can use it in the case of like uh, buy a buying scenario. You just flip the two around. And I recently posted a video today. I uploaded a video on YouTube covering the latest movement of Nasdaq, where I focused in those areas. So you can watch that video to just like catch up and see how I applied um, the principles and rules that I basically gave you. So we don't have much time left. Um, so today's session was just to give you like an overview of what I'll be teaching you, just like to give you an idea of this trading style. It's very simple, nothing that's like clustered on the charts, no moving averages or indicators or anything like that. It's just a few trend lines, then the horizontal lines, not so much. So this is because it's very important to use the simplest way to like set up your analysis, because it will avoid you from making mistakes, because now you're overwhelmed with so much things going on the chart. So having barely anything on the chart is it's a good thing. So next weekend we will be practicing. Uh, I'm gonna send you this session so you can take notes from what I was saying, because I probably
Okay.
moved covered everything so quick, because we only have, I think, about 40 minutes per session, for about 40 minutes. That's the limit. So just quickly make notes and we'll proceed next week. So just make notes, practice a bit, uh, familiarize yourself with this style, and so I will see you next week.
All right.
All right, cheers.
Okay. Thanks. All right. Thank you.
All right. Or do you have any questions before we end the session?
Um, Not really, but based on how I look at the Nasdaq, this place that you mark as a correction,
Okay.
it feels like almost most of those places are most of the The chart looks like a correction to me. I don't know.
Yeah,
Seems like since from April 11th,
yeah,
and then
it's been correcting, but then we did have opportunities within this correction because as you can see here, we had, okay, let me just zoom in. As you can see here, we also had a nice 1, 2, 3, 1, 2, 3,
yeah,
and we also did have uh, the correction, the price got there correctively, it reversed with a huge impulse, giving us the small correction right there. So even if it's in a correction, you still get these opportunities because the goal is to recognize the corrections, the smaller corrections, even if it's within a big correction. So you can see we had a couple of corrections uh, to the downside. Here's another one right there. So even if the price in like big time frame seems uh, rather corrective all the way, within when you zoom in, you will spot impulses and corrections that you can trade without even knowing the overall structure. But this only applies with indices. Remember that because with a currency, uh, you get proper structures where the price moves maybe like this, rather like this, and then, you know, just like Nasdaq. But then with the currency, you have distinct structures. It won't be as messy as indices.
okay.
Okay, so and is there anything else?
So looking for what it should we say triple top or double top right now. Is it a thing? Is it a thing to be looking for too?
Uh, a double top, rather prefer a,
Three?
a 3 because the
Okay.
third touch has the highest probability.
Okay.
Yeah, we have less than a minute